While most people scroll through the news on their phone or check stock tickers, a far heavier burden is quietly growing beneath the surface. A number so enormous, $346 trillion, it barely fits in the human mind. That's the latest total global debt figure as reported by the Institute of International Finance, IIIF, at the end of the third quarter of 2025. That sum is roughly 310% of global GDP. Every government in the developed world, from Washington to Berlin to Tokyo, plays a part. Picture this: a global yield curve flashing red, bond auctions closing with panic, central banks scrambling for liquidity. In Washington, D.C., Treasury officials debate issuing fresh bonds. In Frankfurt, German budget analysts stare at rising debt service forecasts. In Tokyo, a Bank of Japan meeting adjourns with raised interest rate odds. Across London, Paris, New York, capitals and finance centers tremble, not because of one crisis, but because this mountain of debt waits for a trigger. In just the first 9 months of 2025, global debt climbed by more than $26 trillion, the fastest jump in decades. Developed economies led that surge, with the US, China, Germany, France, and Japan among the biggest contributors. A weakening dollar inflated the USD value of local currency debt, masking just how fragile the underlying obligations really are. And it's not just governments. Corporate debt, sovereign bonds, and even safe-looking national treasuries have piled on. As central banks kept chasing growth, cutting rates, easing policy, flooding markets with liquidity, borrowing seemed endless. But here's the catch. Costs don't stay low forever. Interest rates are rising again. Refinancing obligations for both governments and corporations are ballooning. A staggering portion of sovereign and corporate bonds in major economies are set to mature in the next few years. If markets tighten even just slightly, the chain reaction could begin. And when the first domino falls, it won't be a single country default. It could be a wave. Bond markets freezing, banks under pressure, pensions collapsing, currency shocks. This isn't theory. It's 2025. Which makes you ask, what happens next, and can the world survive the fallout? To understand the mountain of $346 trillion, we must go back decades of decisions, often invisible, quietly stacking this global debt. It began in 2008. The world watched as banks collapsed, markets froze, and economies reeled. Governments acted, but the tools were drastic. Central banks slashed interest rates to near zero, and regulators eased restrictions to prevent total collapse. Each decision made sense at the time, saving economies, preserving jobs, stabilizing markets. But each loan, each bailout, added quietly to the debt mountain. Between 2010 and 2015, borrowing surged worldwide. Sovereign debt, corporate bonds, household loans, all grew rapidly. According to the Organization for Economic Cooperation and Development, advanced economies expanded their debt far faster than GDP growth. Governments issued trillions in bonds, corporations leveraged cheap credit for growth, and households embraced mortgages and consumer loans. On the surface, it looked like recovery. Beneath it, the risk quietly accumulated. Then came 2020. The pandemic froze the world. Lockdowns, supply chains halted, jobs vanished. But governments didn't stop borrowing. Trillions of dollars in fiscal stimulus were injected to keep societies afloat. Emergency spending, business support, social aid, all funded by debt. The world survived, but the cost was a turbocharged debt machine. By May 2024, total global debt had reached roughly $315 trillion, according to CNBC. In 2025, after continued borrowing and refinancing, it surged to $346 trillion, as reported by the Institute of International Finance. The mountain was higher than ever. In Washington, Treasury officials debate issuing fresh bonds as interest rates inch upward. In Frankfurt, economists review red lines and projections, concern etched on their faces. Tokyo, Paris, London, New York, all connected. One tremor anywhere could ripple everywhere. Cheap borrowing fueled growth. For over a decade, low interest rates made debt appear manageable. Governments, corporations, and households all embraced it. Sovereign bond markets expanded. According to the OECD, by 2025, advanced economies were issuing record volumes of debt. and investors, domestic and international, absorbed it. Private sector borrowing, corporate leverage, and consumer loans flowed into the system, creating layers of risk across the globe. Global shocks forced more borrowing. Health crises, energy disruptions, inflation spikes, and natural disasters all required state support, adding to the mountain. Between 2015 and 2024, global debt grew roughly 50%, while global GDP growth lagged behind at about 46%, according to international financial reports. Debt outpaced economic growth, meaning countries, corporations, and households borrowed faster than the real economy expanded. Shift from private to public debt. Recent IMF data shows that public debt now dominates, as private sector borrowing has slowed in many advanced economies. Governments now shoulder more risk, and central bank holdings of sovereign bonds have declined in some regions, leaving private investors exposed. Policymakers treated borrowing as a tool, fund growth, provide social programs, invest in green transitions. But every round of borrowing deferred costs to the future. Corporations used cheap financing to expand aggressively. Households embraced mortgages and loans, trusting that good times would continue. This debt is not confined to one nation. A sovereign default in one country can shake global markets. Credit spreads widen, banks face losses, capital flees, currencies wobble. Because of globalization, debt anywhere becomes risk everywhere. So here we are in 2025, $346 trillion in debt, a global tower of obligations, fragile and interconnected. Decisions made over decades, cheap credit, stimulus, expansion, have built the tallest, riskiest mountain the world has ever seen. Here's the part most people miss. It's not just the numbers. It's the timing, the structure, and the hidden dependencies. One wrong move, and this mountain could wobble, threatening economies, corporations, and households alike. By now, you understand the sheer scale of global debt. $346 trillion, a mountain built over decades. But numbers alone don't tell the full story. The real danger lies in the hidden mechanisms, the complex systems that make this mountain not just tall, but precarious. Imagine the global economy as a web, thousands of threads connecting governments, corporations, households, and investors. Pull one thread, and tension travels instantly across the network. The IMF reports that developed markets account for the largest portion of this debt, but emerging markets are increasingly entwined, amplifying systemic risk. Government borrowing is the backbone of this system. In the United States alone, total federal debt recently exceeded $35 trillion, fueled by pandemic stimulus, infrastructure bills, and defense spending. European governments are similarly leveraged. Germany, France, and Italy all carry massive public obligations. Japan remains the most indebted advanced economy, with public debt over 260% of GDP, private and corporate debt. But public debt is only one part. Corporate borrowing has surged, particularly in the US and EU, as companies chase expansion, stock buybacks, and AI investments. According to recent IMF data, non-financial corporate debt in advanced economies now exceeds $12 trillion, while household debt remains high, driven by mortgages, consumer credit, and student loans. Here's where it gets dangerous. Governments issue bonds. Banks buy them. Pension funds, insurance companies, and mutual funds invest heavily. Corporate debt is often tied to these same financial instruments. A shock in one sector, say rising interest rates, can propagate quickly. Higher rates increase government borrowing costs, which stress bond markets, which affects banks, which pressures corporations, a domino effect that no single institution can fully control. Then there are derivatives, complex financial contracts that magnify exposure. Credit default swaps, interest rate swaps, and other instruments are designed to hedge risk. But when markets turn volatile, they can amplify losses. The IIF warns that derivatives linked to government bonds in advanced economies now represent trillions in potential exposure, a hidden amplifier. Another layer of fragility comes from currencies and interest rates. Many governments, corporations, and even households hold debt in foreign currencies. A sudden strengthening of the dollar or euro can dramatically increase repayment costs. Rising interest rates, already underway in 2025, increase debt servicing burdens across developed economies. The combination of rising rates and high leverage creates a system sensitive to even minor shocks. Emerging markets are part of this web too. Countries like Brazil, India, and South Africa hold growing debt denominated in dollars or euros. When advanced economies adjust rates, the ripple hits emerging markets first. Devalued currencies, higher borrowing costs, and potential defaults. The interconnectedness means that a problem anywhere can become a global crisis. Beyond numbers, there's psychology. Investors expect stability, governments project confidence, households assume debt is manageable. But as debt grows, confidence becomes fragile. Panic spreads faster than markets. Fear triggers selling, currency swings, and liquidity crises. Here's the unsettling truth. Even if the mountain doesn't collapse tomorrow, the hidden amplifiers, leverage, derivatives, currency mismatches, rising rates, make the system unstable, like a skyscraper with cracks deep inside the foundation. Imagine a modest 1% increase in U.S. interest rates. On paper, small. In reality, trillions in additional debt service costs. European bonds wobble, banks feel pressure, corporations delay investment, pension funds adjust portfolios, currencies shift, a chain reaction that starts quietly and spreads rapidly across the globe. A recent report by the IMF highlights that advanced economies' public debt alone could face $2 to $3 trillion in additional costs if interest rates rise faster than expected. That's enough to destabilize fiscal plans, reduce government spending, and force emergency interventions. The hidden mechanisms make the global debt mountain more than a number. It's a living, breathing system of interconnections, risk amplifiers, and fragile assumptions. One misstep, one miscalculation, and the world could wake up to a crisis that no headline could fully capture. And the most alarming part? Many policymakers and investors are aware of these risks, but few understand the scale and speed at which a domino effect could happen. The global debt mountain didn't rise in silence. Behind the headlines, behind the calm statements from central banks and finance ministries, there are conflicts, mistakes, and scandals. Decisions that may have made the world less safe. Take Greece in 2010. Decades of overspending, misreported statistics, and opaque government accounting pushed the country to the brink. Investors discovered that the debt was larger than previously disclosed. Bonds plunged. Credit ratings were slashed. The Eurozone panicked. The scandal wasn't just the debt, it was mismanagement and concealment, and the ripple effects were felt across Europe. In the US, corporate debt scandals have quietly surfaced. Companies reported profits while leveraging massive hidden obligations. Analysts warn that if interest rates continue to rise, these safe corporations could suddenly face liquidity crises. The dominoes aren't always government bonds. Sometimes they're private, highly leveraged companies, quietly holding trillions in risk. Derivatives markets are another story. Financial institutions use swaps, options, and other instruments to hedge risk, but some have exposure far larger than their balance sheets suggest. When the 2008 crisis hit, derivatives amplified losses. Today, trillions in government-backed instruments and corporate derivatives remain opaque. Regulators warn, but the public rarely sees it. Even advanced economies have made questionable choices. Massive stimulus packages in the US and Europe saved economies temporarily, but encouraged further borrowing. Low interest rates, quantitative easing, and unlimited bond buying programs increased debt but created moral hazard, the sense that governments can always bail out failures, encouraging riskier behavior. Italy's public debt has hovered near 150% of GDP for years. Political deadlock delayed reforms. Investor confidence wavered. European institutions stepped in repeatedly. Critics argue that opaque negotiations and delayed disclosures created risk for the entire Eurozone. Banks and pension funds hold massive amounts of sovereign and corporate debt. Some of these exposures are poorly reported or hidden in complex instruments. When markets fluctuate, losses may be far higher than anticipated. The scandal isn't just mismanagement, it's the scale and opacity of exposure invisible to most investors. Behind these numbers are humans, policymakers, bankers, executives. Conflicts of interest abound. Some profit from the debt while taxpayers bear the risk. Some hedge funds bet against struggling nations while advising governments. Some corporations lobby for policies that increase leverage even when the public suffers. Here's where it gets chilling. Many of these conflicts and scandals are still active today in 2025. Governments continue to borrow, banks continue to leverage, corporations continue to expand, and the web of hidden obligations grows denser. Imagine a sudden spike in interest rates or a small default in a European nation. Markets shudder, bonds sell off, banks scramble, pension funds adjust, corporations delay investments. The chain reaction spreads across the globe. What starts as a seemingly minor event could expose decades of hidden risk. The IMF warns that even a modest 1 to 2% increase in borrowing costs could add trillions in debt service burdens to advanced economies. That's enough to disrupt fiscal plans, social programs, and financial stability. The global debt mountain is not just a number. It's a tangled web of human decisions, conflicts, missteps, and hidden risks. Every choice, every delay, every opaque deal adds tension to a system already under immense pressure. And the most unsettling part, even when policymakers and investors are aware of these risks, the sheer scale makes it impossible to fully control or predict outcomes. By now, you see the scale, the mechanisms, and the scandals behind the $346 trillion debt. But what does it mean? Let's analyze the consequences, the real impact on economies, markets, and ordinary people. Global bond markets teeter. Investors scrutinize yields. Credit spreads widen. Analysts warn even minor shocks could trigger cascading losses. In the U.S., rising federal borrowing costs put pressure on the Treasury, potentially crowding out infrastructure and social spending. In Europe, heavily indebted nations face rising refinancing costs. Interest rates are central. A 1% hike in global rates translates to trillions in additional debt service costs across advanced economies. For governments, it means less fiscal flexibility. For corporations, it raises borrowing costs. For households, mortgages and loans become more expensive. The dominoes are connected. Currency fluctuations amplify risks. Countries with debt denominated in foreign currencies, dollars or euros, can see repayment costs surge overnight. Trade imbalances also worsen. Import-heavy economies may struggle as their local currency weakens, further stressing debt obligations. High debt limits growth. Governments with large debt burdens have less room to respond to recessions. Fiscal stimulus becomes riskier. Inflation control is more challenging. Even minor shocks, a bank failure, energy price spike, or geopolitical crisis could have outsized effects. USA, EU. In the US, federal debt above $35 trillion strains fiscal policy. Social programs, infrastructure projects, and defense spending compete with interest payments for budget space. In Europe, Italy, France, and Spain face similar pressures, where interest rate rises or investor skepticism can push borrowing costs higher. Germany, traditionally conservative, may absorb shocks, but interconnected EU obligations still create vulnerability. Corporate and household impacts. Corporate debt levels are critical. Companies with high leverage face refinancing risk. Defaults could cascade into banks and pension funds. Households also feel the weight. Mortgages, personal loans, and student debt may become harder to service if interest rates rise or the economy slows. Derivatives, swaps, and other financial instruments magnify shocks. While designed to hedge risk, when markets fluctuate, losses can multiply. Even small events, a minor default or currency swing, can create outsized ripple effects across global finance. 1. Mild shock. Small interest rate hike causes moderate increases in government debt service. Markets wobble but recover. Some corporate defaults occur. 2. Medium shock. Unexpected bond sell-off triggers wider credit spread changes. Corporations delay investments. Governments adjust budgets, cutting programs. Pension funds face shortfalls. 3. Severe shock. Major sovereign or corporate default. Credit freezes. Bank stress spreads globally. Currencies plummet. Stock markets crash. Social and political consequences follow. The global economy is a tightly interconnected system. Debt problems in one Tier 1 country can cascade across continents. Investors in Europe and the US react to Asian market moves. Hedge funds adjust portfolios. Emerging markets bear sudden shocks. The domino effect is real, and history shows us how fast it can spread. Here's the point most people miss. Understanding debt isn't just about numbers or statistics. It's about interconnections, timing, leverage, and human decisions. The system may look stable, but beneath the surface, tension is building, quietly, relentlessly, and invisibly. Debt shapes the world we live in, from what governments can spend to what companies can invest, to how households plan for the future. The $346 trillion mountain isn't abstract. It affects policies, markets, and daily life. So what happens when the 346 trillion debt mountain interacts with reality? It isn't just numbers on a spreadsheet. It affects governments, financial markets, corporations, and ultimately every person who relies on money to live. Governments feel the first pressure. Rising debt service costs force policymakers to make choices, cut programs, raise taxes, or borrow more. In the United States, federal interest payments alone now exceed $900 billion per year, limiting spending on infrastructure, healthcare, and education. In Europe, countries like Italy and Spain face similar dilemmas, balancing social programs with ballooning interest obligations. Corporations are next. Companies with high leverage face refinancing challenges. For example, if global interest rates rise further, many firms may struggle to meet debt obligations while risking defaults that could ripple through banks and investment funds. Financial markets are already sensitive. Following defaults, bond yields fluctuate with perceived risk. Equity markets react to corporate earnings under pressure. Currency volatility rises as investors seek safe havens. Analysts warn that the combination of high leverage and global interconnections makes even minor shocks potentially systemic. Everyday people feel it too. Mortgages, student loans, personal debt all become more expensive as interest rates climb. Inflation pressures, combined with higher borrowing costs, reduce disposable income. Confidence drops. Consumption slows. The economy reacts. The impact is global. Emerging markets, holding significant debt in foreign currencies, face currency devaluation and higher repayment costs. When advanced economies adjust policies or experience defaults, the ripple spreads to Asia, Africa, and Latin America. Investors react globally. Markets tighten. Liquidity dries up. A potential crisis. Consider a sudden default in a major European economy. Bond markets panic. Banks face losses. Pension funds scramble. Corporations delay investment. Currencies wobble. Consumer confidence falls. The result? A global economic slowdown triggered by a single point in the web of $346 trillion. Banks, hedge funds, and insurance companies are exposed to this web. According to recent IMF estimates, derivatives linked to sovereign debt in advanced economies total trillions, creating hidden amplifiers. In a crisis, these amplifiers can magnify losses faster than anyone anticipates. The impact isn't just financial. Rising debt pressures can trigger austerity, layoffs, and reduced public services. Social unrest, political instability, and shifts in public trust may follow. History shows us that high debt and economic pressure can reshape societies, sometimes dramatically. It isn't just a global statistic. It affects your job, your mortgage, your savings, and your future. The ripple may seem distant, but in today's interconnected world, distance no longer protects you from risk. Debt shapes economies, influences governments, affects markets, and touches every household. The mountain of $346 trillion is more than a number. It is the silent force shaping policy, investment, and lives around the world. And the unsettling truth? The higher the mountain grows, the more fragile the system becomes. Every decision, every policy, every market movement now carries the weight of centuries of borrowing. We've explored the story of $346 trillion, the hidden mountain of debt towering over the global economy. From the financial crises of the past, to pandemic-era borrowing, to corporate and household leverage, to hidden mechanisms and scandals, the picture is clear. This is a system both vast and fragile. The numbers are staggering, but the implications are human. Every decision by policymakers, bankers, and corporations echoes across markets and lives. Every mortgage, every loan, every bond contributes to a global web of obligations, interlinked and delicate. Global debt has reached unprecedented levels, surpassing $346 trillion. Public, corporate, and household debt interact in ways that amplify risk. Hidden mechanisms, derivatives, interest rate sensitivity, and currency exposure make the system fragile. Even minor shocks, a small default, a rate hike, a policy misstep could trigger cascading effects. The future is uncertain. Governments must navigate debt carefully. Corporations must manage leverage responsibly. Investors and households must understand risk. Awareness is the first step toward resilience. And here's the final point. The $346 trillion debt is not just a number on a page. It is a force shaping economies, influencing governments, and affecting every one of us, silently, relentlessly, and invisibly. If you found this breakdown insightful, make sure to subscribe to Money Hub for more deep dives into global finance and economic mysteries. Hit the like button, share this video with friends who care about understanding the world of money, and comment below your thoughts on the $346 trillion debt. Every subscriber helps us create more content that exposes the hidden forces shaping our world. Stay informed, stay curious, and remember, in finance, knowledge is power. Thanks for watching Money Hub. Until next time, keep your eyes on the numbers that move the world.